All right, welcome back to Bazaar Morning Call. As promised, we're going to discuss about the auto ancillary space. Now, there's a massive energy crisis in Europe. Gas prices in Europe have hit a record high, above £343 per megawatt hour, and that is threatening to trigger a recession. Now, there are a pocket of auto ancillary companies, to the likes of Endurance Tech, Varroc, etc., that get revenues from there. Endurance Tech, in fact, gets 25% of its consolidated sales from the European markets and has been already hit by this crisis. Ramesh Gehani, the Executive Director and CEO of Endurance Tech, joins us now to talk about that. Mr. Gehani, good morning. And things have only escalated out of control since we spoke last. I remember you telling me that, nothing will improve until the gas prices settle down in Europe. And far from it, it's actually only gotten worse. What do you think the impact of this would be on your own business for the rest of the fiscal?
Good morning, Sonia. Good morning, Sonia. Yes, I said this last time also, and I repeat that unless the gas prices and energy cost doesn't, seemingly come down, the challenges in Europe are going to multiply. Now, when we are talking about Q1 of last year, when the gas prices were just about $17 a megawatt, and now it's close to 100, which is 5 times. And as we talk, July and August has gone further deepening to somewhere around 100% more over and above where we were. So this is probably one of the biggest challenges and things which Europe is facing all across. And I strongly believe that unless until the war situation doesn't end up or something, and the gas prices don't come down, the prices and the business model will continue to be under challenge and difficult situations.
Mr. Gehani, just a basic question. When we talk about European gas prices and electricity prices going through the roof, do businesses pay whatever we hear, the $750,000 a megawatt? I mean, or it's subsidized. By the time the businesses pay, the state steps in, subsidizes a large portion of it.
See, you'll agree one thing, that subsidies don't work in long run, and you can only ease out the situation by giving some subsidies here and there, but it doesn't work out in the long run. What I understand that now we're talking about power cuts to the extent of 6 to 8 hours a day. Now, if that happens, which is likely also, if that happens, then the pressure on the industry would be far more. Some of the industries, some of the low-ended auto ancillaries, they might even shut down because they would not have the muscle power to bear this, this challenge of electricity cost. Because beyond a point, how much can you spend from your own? So this is a challenge. The OEMs would probably be in a position to recognize this cost in coming days.
But does the state step in, sir, Mr. Gehani? Do the state step in, or do the businesses actually pay this? I know, I mean, long term, I take your point, but what's happening on the ground now?
No, the industry doesn't get any subsidies.
So you pay whatever the tariffs are on exchanges, right? So you got to buy power at those rates.
Yes, we've got to buy power at those rates.
So just one follow-up to what you were mentioning earlier. What does a company like yours plan to do? Because so many of your peers have, taken quite drastic steps. I mean, Varroc sold part of their European business because it was loss-making for so long. Would you at any point look to sort of cut your losses, either sell the business, or what seems to be the plan now?
See, selling the business, you asked this question to me last time. I said a clear no, and I repeat that because Endurance has worked on a very promising business model in Europe. It has complete synergies with the kind of business that we do in India also, and the kind of business we do over there. See, in spite of all these crises, if we are sitting at at EBITDA margins of 11.5, that itself demonstrates or reflects that we are in a fairly strong position, even under the present conditions also.
Mr. Gehani, so not selling the business, you're reiterating that point. What about separating both the businesses? Since there is, Europe is going through a bit of a lull and things are expected to remain volatile out there. Global factors, global risk is at play. Will you look at separating both the businesses, demerging it?
No, certainly not. Because, see, both businesses have got their own independent, strength and business performance. The OEMs out there or the customers that we have are very strong. It's only a matter of recalibrating the whole business environment over there. I'm sure, as I speak to most of my OEMs, everybody's recalibrating itself, not for today, but probably 2 years or 3 years down the line when they don't depend on Russian, gas or electricity from anywhere outside. They're all trying to build themselves and make themselves self-reliant.
All right, Mr. Gyani, given the challenges, given the improvements in raw material cost and, this chip shortage issue, etc., what is the revenue growth number you're looking at for both the businesses? That's for the India business as well as for the Europe business. And, could give us a blended margin that we should be working with from here on.
Okay, that's a good question. Normally, I don't give forward-looking numbers, but let me give you a flavor. See, we are right now at somewhere around 39% in Q1 higher than previous year, but that is not truly comparable because we had some lockdowns during the previous period. But the numbers are moving up, and the volumes are ticking up. Some chip shortages have eased out, right? We have got all the chips or all the products that we wanted to have, and those numbers are increasing. The OEMs have got probably better allocations from the chip suppliers. So even high-end bikes and vehicles are being made. So I don't think that numbers are under any challenge right now. It's only the commodity prices which are now softening down. The earlier impacts were higher, but going forward, as the commodity prices come down, I am pretty confident that we will be able to touch the previous levels, or rather say that would be our endeavor to touch the previous levels of somewhere around 13.5 to 13.5 or 13.6%.
Okay. Even demand in the European region is under pressure, right? We've been talking about how costs have gone up and gas prices have escalated. But look at the demand. I mean, in Q1, only 2.7 million new cars were registered. That's a 16% drop compared to what we saw last year, which was also challenging given COVID. Why do you think that is? And will that continue to be the order of the year? I mean, slowness in demand there?
Yes, that would be continuing, because right now, if there are certain supply chain partners which are not able to perform and they challenge the business model of the OEMs or the new car manufacturing, then it will be an issue. Because if you don't have the entire supply chain in a good health condition, you can't be making as many number of vehicles that you want to. But what the OEMs are concentrating on is high-end premium vehicles, in which probably they make more money, and those stocks are not there at the retail level. And that's why the waiting period of getting a new car would be as high as 15 months to 18 months.
Okay. Just a quick word on electric vehicles. I think you took in new orders of almost about 500 crores in the first quarter. And you said about 25% of that is from the EV space, where margins are higher because competition is a little limited. Could you give us an update now in Q2? What is that segment doing for you, and how much can that cushion the overall margin impact? Higher supplies to EV players.
Okay. 484 crores was the new business wins that we had in Q1, out of which 110 crores was for EV space. Now, what is moving forward for us is primarily brakes and castings. Of course, we would like to service all our product verticals to the EV players. But the numbers, and although we started a bit late on the EV space, but now we are actively involved. Our total order book, including last year, is close to somewhere around 300 crores. We are aggressively being engaged with the OEMs, and so are the OEMs coming back to us for, especially to start with, is brakes product verticals, where the orders are pretty good, and margins certainly are better, because you said that there are lesser players, but it's only a comparative basis. I'm sure once the volumes come into play, the whole pricing structure will be reworked.
All right, Mr. Gyani, very quickly before we let you go, you don't want to sell the European business, but you've hinted in the past that you're on the prowl as well. You're looking at various acquisitions, maybe that could spruce up things on the EV side. Anything we should be looking forward to, maybe in the next couple of quarters, that Endurance Tech can close out?
Right now, I can't think of any acquisitions, although we recently made an acquisition for friction material for the aftermarket space in Europe. But it's not a good time to look into any acquisition opportunities right now. I think what is more important is to stabilize and recalibrate yourself to meet the existing business environment over there, rather than looking into new ventures.
Okay, we got the guidance on the margins you see over the next few quarters. Hopefully it goes back to the 13.5%. But I missed out the revenue growth number for this year. What was that? Consolidated revenue grows to what level?
No, I said in Q1 we are up by 39%, right? But see, revenue growth and all, we should be looking at from one angle, that if the commodity prices come down, then probably we are talking of a comparative basis, because right now the revenues may be higher, seemingly higher, because earlier quarters, the commodity prices were higher and there was some impact of aluminium. and steel onto the total final product of pricing.
But double-digit growth, revenue growth at least, mid-teens.
Oh, certainly. See, I can only say one thing, that our history says that we have always performed better than the industry. And I continue to say that we will maintain that status.
Good speaking to you, Mr. Gyani. Thanks so much for joining in, giving us a sense about the pain in Europe. You're optimistic on business going ahead as well. And you're not looking to sell the European business. And you don't believe it's the right time to go for inorganic growth as well. Appreciate you joining in. Moving on to the next management, though, we have Century Ply. They are the company on our radar. Remember, the company posted a rather good set of numbers, on a year-on-year basis. Sequentially, though, margins slipping close to around 170 basis points. To discuss the outlook as well as demand trends from year on, well, we're joined by the management currently on the show. Hester, thanks so much for joining in. Well, let's get in a couple of numbers then. Earlier, you were talking about a 15% growth on the revenue aspect. Could you tell us whether or not you stick to that? And what about margins? Select input costs have cooled off while you have some kind of easing as well. What do blended margins look like, Keshav, from here on?
Good morning. Thank you so much for having me on the show. In terms of revenue growth, we are still quite bullish. I think we will meet and exceed the guidance that we have given. The market remains good. Short term, there is a little bit of pressure because of raw material inflation, as you have mentioned. But I think with that easing out now, going forward, the rest of the year looks quite strong. On the margin front, we have maintained that we will do 13 to 15% EBITDA in plywood, 14 to 16 in laminates, and 25 plus in particle board and MDF. And I'm sure we'll be able to meet those numbers.
Okay, in fact, your plywood segment, Keshav, has done exceptionally well. It's doubled compared to what we saw last year. And I guess expectedly so, because demand for real estate, etc., has gone up in a big way. Tell us, what will the sustainable growth rate be, particularly for the plywood segment?
You see, last year, the base was very low because Q1, COVID had impacted substantially, and we were very badly affected in the plywood sector. But yes, this year, we have done well in the first quarter. Going forward also, we are confident of good growth. I think 15% plus growth for the year looks achievable.
That's for the plywood segment. So this 15% growth, what does it mean in terms of the margin picture? Because I reckon that your margins may also move to double digits. You're almost there now at 9.5% margins for the plywood business. How much could it move up by?
I think on an annualized basis, our target was 13 to 15%. Q1, because of raw material pressure, was substantially lower. But we also front-loaded a lot of our marketing expenses. Going forward, I'm very confident that we should reach 13 to 15% before the end of the year. Second half of the year, H2, we should hit those numbers.
Mr. Bhajanka, is there any demand issue in the near term which is emerging? I was talking to someone who was pointing very markedly to that, saying that it's not. There seems to be some demand issue near term for whatever reason. I mean, can you confirm that?
I think, yes, demand is not as robust as it was, perhaps due to, the raw material costs going up substantially. If you look at homes, cement, steel, everything has shot up. But I think it's a short-term phenomenon because if you look at the basics, real estate demand is still very good. I think residential real estate sales have been posting record numbers. So short-term, a quarter, 2 quarters, there might be a little pressure. But otherwise, we are very confident that, demand is going to be robust. And us being the industry leader, we're going to grow faster than most.
All right, Keshav, your shareholders, I think, are liking what you're saying because as we speak, the stock has moved to the high point of the day. It's recovered most of its losses. But, even customers will want to know, what's the plan? Are you going to be increasing prices from here on? Give us a sense on that aspect. Quarter 1, you took some price increases. Quarter 2, have you taken? If yes, what is the quantum? And also, what is your market share? Since you're growing at a faster clip, you would be gaining market share, right? Quantify that number.
Yes, definitely. Our market share was closer to 5%, prior to COVID, and I'm sure we have substantially increased that. The only problem is that in our industry, getting proper data is a bit of a difficulty because of so many unorganized units being there. But you're 100% correct. We have definitely increased our market share. In terms of price increase, earlier you mentioned that raw material prices are somewhat cooling off. So right now, I don't see any further price increases. the price increase we took in Q1 was due to raw material costs, but now that is sort of tapering off.
So what's the market share now and how much has it gone up by?
Again, it's a little difficult to quantify because of, but I'm sure that we would have increased our market share from, say, a 5% to at least a 5.5% or more.
Okay. And what do you think the sustainable realizations could be, even in terms of volumes for MDF, for that segment? I think in FY22, your realizations were about 31,200 or so. How much could it go up by?
For the current year, we had forecast that, we'll be at a similar realization. Right now, they're a little bit higher and there are no signs of any price reduction. So perhaps they'll be slightly higher on the MDF side than last year.
All right, Keshav, thanks so much for stopping by and filling us in with all those details. Demand a little bit softish. You believe that it's temporary, looking at gaining market share and confident on growth as well from here on. But guys, I think the markets are calling for our attention. 180 points from the low point of the day. Look at the breadth of the market. 180 stocks were advancing earlier. Those lines are getting a little bit closer at least. You have from 180 stocks, you have nearly around 550 stocks that are advancing, at this point of time. And just take a look at some of those stocks in the broader markets. BHEL, the stock was down 3%. Now it's up close to around 3%. So there's a big recovery out there. Escorts Kubota as well. That's a big recovery on that one. And Lotus Laboratories as well. So Sonia, as you said, plenty of stocks in the broader markets. Well, they're doing a thing of their own. It
feels like the match yesterday, until the 15th over, it was a roller coaster ride. A lot of high on emotions, but after the 15th over, things sort of took a turn for the better. And that's what's happening in our market. 150-point recovery now on the Nifty.
We'll have to find a Hardik Pandya and, Jadeja for the day. But the Bulls are, they made a good comeback.
Okay, well, let's see what Reliance does and how it sort of changes the game for the market. That's the big cue for today. At 2 p.m., we have the 45th annual general meeting of Reliance Industries that will take place. Reliance's latest venture has been the new energy business, and that could be the focus of the AGM this time. Sonal is here to tell us what the market will be watching out for. Sonal.
While the big focus in the AGM is expected to be on the new energy business, company has already completed acquisition and investments to the tune of 5,500 crores so far to build capabilities in the new energy value chain and created multiple subsidiaries last year just for the new energy business. In fact, in the annual report, company focused extensively on the plans in green energy space. Renewable appeared 65 times in the report itself. Company said that India will have the world's most affordable green energy within this decade itself. And over the next 12 months, green energy investments made by Reliance will start going live. And new energy will outshine the existing growth engines in just next 5 to 7 years. So in terms of expectations, more details and potential timelines in terms of execution will be watched out for under various projects, and greater clarity on new energy capex will surprise the market positively. On the oil to chemicals bit, company mentioned how FY22 saw a lot of volatility in the energy market, but Reliance Industries has been able to weather that. So company's strategy in FY23 is something we'll watch out for. Company also spoke about how in this segment particularly, they have been optimizing costs. Additionally, if there is any clarity on either the listing or potential stake sale in the oil to chemicals business is something we'll be watching out for. And lastly, company has plans of decarbonizing the O2C value chain, and the capex plan here will give some more clarity to the investors as well.
Sonal, thanks very much for that. Now, Mangalam is here to tell us about the expectations from the retail side of things. Reliance Retail just reported numbers as well, strong set of numbers for the quarter and for the year. Mangalam, over to you.
Well, FY22 was a tough year for the industry at large as we were battling through multiple waves of COVID as well. But in that, Reliance Retail actually did well, reported record revenues and EBITDA. And importantly, you saw the company invest in the future as well. The revenues neared that 2 lakh crore mark, and the company added 1.5 lakh jobs as well. Some of the key milestones that the company achieved: 2,500 new stores added, almost 8 million square feet of retail area added, of which nearly 3/4 were in Tier 2 into and beyond cities and not just metros. They doubled their warehousing capacity, as well as registered customers increased by 24% in FY22 as well. At the back end too, we saw a 3 times jump in their merchants, and digital now contributes 17% to their revenue versus just about 10%. But the big headline was the near 10,000 crore investment that the company did in a lot of companies, minority, majority, as well as strategic. So starting with companies like Just Dial, 7-Eleven, Milk Basket, Clovia, tie-ups with brands like Ritu Kumar, Manish Malhotra, the who's who, Abraham Thakur, we had Abu Jani and Sandeep Khosla as well, and notwithstanding the $200 million investment that we saw in quick commerce player Dunzo as well. So to that extent, announcements would be extremely crucial to watch out for. As we speak, Reliance is the 56th among top global retailers and the second fastest growing retailer in the world. And remember, the previous AGM, Mukesh Ambani had said that they would grow at least 3 times over the next 3 to 5 years, and importantly, will be among the top 10 retailers in the world. So that's about Reliance. Any announcements in the AGM with regards to that, the digital ecosystem in the retail business, value unlocking will be extremely crucial to watch out for, and expansion of retail offerings and synergies between the acquisitions that the companies made. They've made the investments. Now it's time to reap them.
Okay, and what about the commentary to watch out for from the telecom business? Everyone's looking forward to whether they announce a timeline for the listing of Reliance Jio. But Rima is here to tell us what to expect. Rima.
5G-related announcements are expected to take center stage at the AGM. Remember, Jio spent a whopping 88,000 crores in the recently concluded auctions, twice that of its closest peer, and they even lapped up that expensive 700 megahertz spectrum, which went unsold in the previous auctions. In terms of specifics, expect clarity on the rollout timelines of Jio 5G. The annual report had highlighted how Jio has completed plans for coverage, customer demand for the top 1,000 cities in India to roll out 5G. And its aim, which it outlined in the previous auction, or in the previous AGM, was to make India 5G yukt. Now, another point to note is that the AGM is often used as a launchpad for new phone releases. In the last AGM, the company showcased Jio Phone Next, the world's most affordable, full touch screen 4G phone in collaboration with Google. In this AGM, the big question is, will Jio announce the launch of the company's first 5G phone, Jio Phone 5G, or even give an indication that it's working on one, and how affordable will it be? Another event that everyone is watching is a Jio IPO. Will we get any update on the timelines for an IPO at the upcoming AGM? That will be a big one to watch. Now, Mukesh Ambani has already got the ball rolling when it comes to succession planning by appointing Akash Ambani as the chairman of Reliance Jio Infocom. Now, as we wrap this up and wait for the actual AGM announcement, just want to put into context the size of Jio. The annual operating revenue for Jio platforms crossed $10 billion last year. Jio's network carried 10% of the global mobile data traffic in calendar year 21. Its subscriber base is well over 400 million subscribers. And finally, Jio Fiber, with more than 5 million connected homes, has become the largest fixed broadband provider in India within just 2 years of launch.
All right. Thanks very much, Rima, for that. Now, the big picture, Nisha is joining in terms of what are the expectations from the mega event a little later today. Nisha.
Let's take a look at the big picture. Now, the AGM has been a big affair for the conglomerate Reliance Industries since time immemorial, and the promoters have often made some high-voltage announcements to its large shareholder base. Now, as a large diversified group, this year is the year of capital expenditure in the new energy business, on which, remember, Mukesh Ambani had made a big bang announcement last year of a whopping $10 billion of investments in 3 years. Now, an update on how much has been committed and what lies ahead will be the key to watch out for. Now, the telecom vertical Jio has been preparing for its 5G rollout plan, especially after the spectrum auctions are over, is an important milestone for the group. And also Jio milestones are important as the company shows signs of steps being taken to prepare for an eventual IPO. Now, the investors in Jio platforms have already been waiting for their value unlocking through a listing. Similar is the case with Reliance Retail with its large investor base. Now, Mukesh Ambani, remember, had announced the IPOs will be done in 5 years in his 2019 AGM, and next 2 years could be quite eventful on the IPO front. Now, big talking point in Reliance Industries is the next gen taking over important executive roles in the group companies. We see the succession plan unfold slowly over the next year. First step, remember, in this direction has already been taken with Akash Ambani taking over as the chairman of Reliance Jio Infocomm. Isha Ambani on retail and Anant on energy to follow. Reliance has taken many steps to be viewed as a truly global company, and therefore the aggressive target of being net carbon zero by 2035 is also in the works. Its progress also adds to the premiumization of its equity and perception building on the global stage. So all eyes on Mukesh Ambani's speech at the AGM.
Okay, folks, thanks a lot for that. So those are big events to watch out for. Of course, Network 18, the channel that you're watching, is owned by Reliance Industries. So that is the standard disclaimer there. Let's take a quick break on that note. For the market, as we've been telling you, it is a recovery that we've seen from the lows to the tune of almost 150 points. The lows were 17,166. We're back above 17,300, but getting to be a choppy day of trade. Mitesh Thakkar will join in for some technical trades on the other side of the break. So do stay tuned in.
Welcome back. I mean, we are up and up smartly. 160 odd points from the day's low, 17,309. Mitesh Thakkar is with us. Mitesh, I mean, it's a pretty smart, impressive bounce we've seen so far. What do you make of it, and what would you advise one does?
Good morning again, Prashant. I think, while we have had a good recovery from the day's low, I think the gap still remains unfilled, and then the issue of 20-day average at 17,390 is still pending. So I think unless we go beyond that, I would not be very aggressive to buy the markets. But yes, some stocks are showing very good traction on the upside. So we've kind of tried to identify them and maybe explore longs over there. Petronet is something which is trading in the positive. It's showing a good setup overall. That's a buy with a stop below levels of 217 for targets of 228. And BHEL is something which had a very strong recovery. The medium-term charts are very positive over here. I think this is a better chance of outperforming the markets. That's a buy with a stop at 57.5 for targets of 63.
Okay, all right. Some stocks, I mean, stock specific, basically. And of course, I mean, Mitesh is highlighting the 20-day, which needs to be crossed, which is still some distance away, some 80 points away. Mitesh, thanks very much. We'll come back to you a little later. Let's shift focus to some specific stocks. Ekta is tracking Cipla and Glenmark. Ekta, morning.
Well, yes, I'll start with Cipla, which is in focus because they have received 6 observations from the US FDA for their Goa facility. Now, why is this important is because the Goa facility has a warning letter issued to it all the way back since Feb 2020. So the street was watching for the outcome to indicate whether or not this particular warning letter could be lifted for the Goa facility for Cipla. Now the company has said there are no data integrity observations, but there is some referencing made to earlier observations and an earlier inspection of September 2019, remember, which is one of the possibilities for that particular warning letter eventually being issued after that September 2019 inspection. Now the street is possibly factoring in a delay in a couple of key drugs which are filed from this particular facility, such as the cancer drug Abrixon, which is estimated to be around 2 to 4% of the company's core EPS. Separately, Glenmark is in focus because their Goa plant has now been classified as an OAI, or an official action indicated status, which means that the risk of any kind of regulatory action could possibly increase. The US FDA might withhold any kind of approvals from the facility unless they feel that the observations are well taken care of. This particular plant was inspected in May of 2022 and was issued 5 observations, which has now turned into an official action indicated status.
Ekta, thank you very much for that. So keep an eye on those names. Well, the markets market is trying to pull back. Although I have to point out that futures premium, which we started, even today, we started with a 100-point premium on futures on top of spot. That is now 50% of it, just 50-point premium, which is still large, but a 100-point premium was the highest in the last 1 year or so. So let's see, 17,309 is where we're at. It's very stock specific, and we'll continue to cover the market for you in some detail as we go along. Time for a quick break. On the other side, our segment, it's the economy. My colleague Lata will chat with Vishnu Varathan, Executive Director, Head Economics and Strategy Asia, Treasury at Mizuho Bank, to discuss the hawkish Fed speech at Jackson Hole last Friday.
The key takeaways from Jerome Powell's Jackson Hole speech appear to be, first, Powell is very strongly focused on the 2% inflation, perhaps a little more than what the market is giving him credit for. Takeaway 2, restoring price stability is going to take time. He says Powell seems prepared for a sustained period of below-trend growth. So even if growth is bad, they won't flinch. Takeaway 3, in September itself, he is quoted largely from the July statement, but the general impression seems to be that it could be another 75 basis hike, though, of course, he did say the FOMC will be data dependent. Takeaway 4, he said inflation is due to higher demand and constrained supply, but that's not going to change the resolve of the Federal Reserve to bring down demand in sync with supply. Important. Takeaway 5, he said longer-term inflation expectations do appear well anchored, but that's not ground enough for complacency. And the most important, takeaway 6, historical record cautions against prematurely loosening policy. The lesson from the 70s and the 80s, he said over and over again, is that if we waver now, then a lengthy period of tightening will be called for, giving the impression that there is no cut in his horizon. Now, the impact of the speech on the market, the CME Fed Watch tool is now showing that the chances of a 75 basis point hike has risen to 61% from 47% in the previous week. Also, all emerging market currencies have opened with cuts of between 0.2 to 0.8%. The rupee itself has hit a fresh low, all-time low of 80.12, but then a goodish bit of Reserve Bank selling of dollars has brought it back to the 80 mark. Joining me now to parse the impact of the Jackson Hole speech from an emerging markets point of view is Vishnu Varathan, Executive Director, Head Economics and Strategy Asia and Oceania Treasury at Mizuho Bank. Well, Vishnu, thank you very much indeed for joining us. Now, according to this CME Fed Watch tool that I referred to, chances of a 75 basis point hike in September has gone up to 61% from 47%. What is your own expectations in September?
I think, to be very frank, our own estimate and our own, forecast was for 50 basis point hike. But I think the fact that he has reiterated this point and particularly come to the aspect of inflation expectations means markets are probably correctly pricing in that there's a higher chance of 75 basis points rather than 50. But if we take a step back, the bigger picture is that from June till September, the entire Q3 or rather Q2 to Q3, we haven't backed away from the big question remaining the same. And that question is, it continues to be, is it a 50 or 75? So the Fed has got no chance and no room at this point to scale it back to a question of 25 or 50. So in other words, 50 continues to be the new 25. And I think now markets, the bigger question for them is whether in November and December, the Fed will have any scope to step back to a 25 basis point hike. And regardless of the current pricing, two things that will determine this are incoming data, and perhaps in September, very importantly, the revised so-called dot plot, the median of the Fed forecast.
Of course, we will watch for the dot plot. But Vishnu, would you say the real big takeaway is that there is no cut in 2023?
I like that you hit the nail on the head. And I think that was one of the biggest takeaways as well, because one particular point that he continued to, or that Fed Powell emphasized on during this meeting is that they need to hold rates restrictive for a relatively long period, even if that meant having to deal with a sustained period of below trend economy. And so that has been one of the bigger revisions in terms of how markets are pricing this. The peak rates are perhaps not going to come through as emphatically in the early part of 2023. And I think the dot plot will confirm that perhaps the rates may remain elevated through 2023. So to your point, expecting and hoping for a rate cut in 2023 may be a little bit overdone.
Okay. Yeah, we will again look for the dot plot. But what are the chances, Vishnu, of the Fed funds rate going even above 4%?
I think these chances are increasing, and to be clear, he did, Fed Chair Powell did not expressly allude to this, although he did mention, in between the lines in terms of the three lessons that they have, having to act decisively, unconditionally, and ahead of expectations. But just before Jackson Hole, we've seen even the less extremely hawkish members of the FOMC suggesting that they see higher rates. And I'll give you two examples which may be guiding in terms of how the FOMC may be moving towards. Esther George, Esther George, I think expressly said that 4% may not be ruled out. And James Bullard had an even more fundamental suggestion that maybe 2.25 to 2.5% may not be the neutral rate, and the neutral rates might have moved up one way or the other. This is knocking up against 4%. So assumptions that will definitely halt before 4%. That is also looking shaky at this point of time.
Okay, we'll have to wait and see how the markets react to that. But today, we already know that the emerging market Asia currencies have fallen between 0.2 and 0.8%. Now, do you see more weakness in EM currencies? Particularly, what's your view on the rupee?
Well, we do think that in the near term, at least heading into September and the early part of October, there are two key reasons why we can get more weakness in EM currencies. First of all, today's weakness is perhaps understated because as we were heading into the Jackson Hole, markets were already accounting for a stronger dollar. So it may not fully price in the extent of hawkishness. The other reason is heading into September and October, there are two things that are going to happen. One is not only is the Fed likely to deliver at the top side of the 50 to 75 basis point hike with still hawkish comments, but the dot plot is also likely to be somewhat more aggressive. And we may also be bracing for a doubling of quantitative tightening to 95 billion a month from 47.5. So the confluence of these factors suggests the dollar is likely to remain underpinned and supported. And the other reason is even if the ECB and the Bank of England are turning more hawkish, they fall far short of the Fed. That's one. And the other is they face far greater recession and stagflation risks, which is to say the alternative of going into the euro and sterling are less compelling. And that by default means that the dollar is likely to retain strength for longer into this global tightening cycle. So we don't want to dismiss the dollar as having peaked in Q3 just yet. To the question of how much further EM currencies can go down, our suspicion is this is somewhere in the ballpark of say 2 to 5%. We do expect the dollar rupee to at least fleetingly test above 80, getting close to 81. But there may be some relief from any coincident softening in oil prices due to the rising recession risks that come along with aggressive Fed tightening.
Okay. Well, let me come to India. The Indian growth story has been pretty strong in the first half. Can this growth be hurt by slowdown in China and eventually slow down in the US as well?
So I'm just going to be a little more provocative here. I'm going to suggest that actually US-China may be a medium-term boon for India, because that means you would get a lot more investments heading India's way, insofar that many multinationals and all will have to hedge away from China. So in the medium term, I see it to continue to bolster and burnish India's underlying strong fundamentals. In the near term, however, the fairly strong first half, and by that I mean the first calendar half performance, may be overstated by base effects, because even if we expect double-digit growth in Q2, the fact of the matter is, compared to pre-COVID, it's up barely 4%. So it's just an ongoing recovery distorted by base effects, whereas the incoming headwinds alongside a tightening RBI and components of inflation, including food that looks sticky, means that the path ahead might be bumpy. And I think getting to the trend growth or potential growth between 7 and perhaps even 8% may have to be deferred out beyond 2023.
Let me take that provocative part. You know, according to you, which is the most attractive economy in Asia, EMs? And is India likely to see good foreign flows, continue to see good foreign flows?
I think India is certainly one of the most attractive, because it's got the dual allure of being a fantastically big manufacturing base with economies of scale and supportive labor force, as well as a domestic market. So that twin engine is fantastic. But that's perhaps over a longer timeline of, say, 5 to 15 years. The immediate reflex, I think, favors countries such as perhaps Vietnam, to a lesser extent Malaysia and Philippines a little more, just due to the fact that it will be easier for them to plug into existing logistics and infrastructures. So that's how we look at it in terms of deferring horizon. But I think there is every evidence to suggest that FDI flows into India will continue to be very supportive once we look past some of the near-term bumps in the global economy.
Good to hear that, but actually my question was with reference to portfolio flows. Now, FPI flows did return in August. Are they likely to continue, or do you think they'll take a break with all this hawkishness?
That's a really good question. And sorry, I went the FDI route earlier. For FII flows, we expect that it will resume, but not in a linear fashion. I think there are still some bumps and air pockets ahead, in particular due to the whole concept of higher for longer US rates coming through. That will need to be factored in. The inflation differentials is another one, because we probably have probably see a sign of US inflation peaking a little bit before Asia and India's inflation peak. So the inflation differentials going the other way, favoring the US, also means that some of the capital flows will at least be interrupted for the rest of the year. And so it's not going to be an unimpeded improvement in FII, but looking beyond that, there would be a greater alignment between FDIs and FIIs, because you go back to underlying fundamentals, and then I think we will start looking at a more sustained and robust recovery in the FII.
Okay, we will take your medium-term optimism with both hands. Thank you very much, Vishnu Varathan, for joining us. We have to wrap up on Bazaar on that note with the news that the equity indexes have shown a decent bounce back, but two events are there. When London opens, we could see, we have to see how foreign funds react. And secondly, by 1 o'clock or 2 o'clock, we are going to get the Reliance AGM speech. So both those can have an impact on the market. We wrap up on Bazaar. Chart busted up.